Today, thinking about banking from the inside. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today I have a very special guest to join us, John Dahlsen, who you may know was an ANZ director some years ago. John, hello, welcome to the DFA.
Hi.
Thank you very much for spending some time with us. I guess just to give our viewers a little bit of context, you've been in business for many years, but you've also been involved inside the governance of one of our biggest financial services organisations.
Yes, I have. I was director of ANZ for 20 years. I retired about 14 years ago, so I feel I'm free to talk. And I spent a lot of time as chairman of the Audit and Risk Committee and then just the Audit Committee. So I have, as of 14 years ago, I emphasise, a reasonable knowledge.
And of course, you've also been in business in your own right, so you are actually speaking more generally as a business person as well as just.
Well, I was chairman of Woolworths, and I was chairman of the Herald Weekly Times and Southern Cross Broadcasting, and I'm in a voice situation where I own a substantial business in my own right, which is trade business, Dhalsim Building Systems, which has got about 60 sites across Australia. So I'm very privileged in that I've been at the top end of business and a small end, and I claim to have a balance between big and small. I have to say, though, I'm now currently very passionate about the interests of small business, and I've done a lot to help small business in one way or another.
Well, small businesses, of course, are the dynamo, the engine of the economy, aren't they? So they're absolutely critical sector of the economy.
Absolutely.
Yeah. And sometimes get the damp end of the stick, as we may discuss a little bit down the track when we talk about some of the behaviours in the banks.
Yes, I could talk for a long time about that.
Well, maybe we'll touch on that as we go through. I guess a good place to start the conversation is, the Royal Commission came out with its draft report a few weeks ago, and basically I think made a whole bunch of comments. But for me, there were really two that stood out. The first was greed is driving a lot of the behaviour in the banks, firstly. And secondly, the banks aren't really focusing on their customers. They're focusing on maximising the returns to their shareholders. Now, as somebody who's been inside one of these large organisations from a government's perspective, did those conclusions surprise you or not?
No, they didn't. And the interesting thing is that it was nowhere near prevalent in my day. And what I've noticed is that there's become, in effect, a contest between the banks as to who's got the highest return on equity. And the banks tend to highlight that statistic. And of course, what that means is how much revenue they can earn and how much revenue they can earn at how little cost. So what in effect they've done, they've put the squeeze on the organisation to maximise that return, and in the process have lost sight of the customers.
Right. And, one suspects part of the reason is you've got these big international investors who are holding shares in the banks and, of course, apply a lot of investment performance pressure on the banks.
I think that's being, in the debate, I think that's being overlooked a bit. And I think one must have some sympathy with the banks, because there's absolutely no doubt that short-termism is prevalent. And that the institutions, particularly the international ones, are driving short-term quarterly behaviour. And that problem exists in a number of other sectors. The banks haven't got it alone. But one of the interesting things about banks is that by the reason of them being banks, they're very financially driven, and figures and statistics are at their fingertips all the time. So it's easy for the analysts and the investors to use these statistics like return on equity to drive the bank's behaviour. And but in fairness to the banks, this problem exists elsewhere, and it should change. One interesting thing I've noticed about that is some companies are saying at the moment, look, if you want to invest in me, don't expect short-term results. We're going to run this company in the longer term. We're going to run it for 2 or 3 years. So please don't invest if you're a short-term investor and put the wrong kind of pressure on it. Now, I think that's an interesting approach to the problem. And I think that if boards do that, I think they can overcome a fair amount of this short-termism.
Yeah, very interesting point. And I guess the question to my mind is, if in fact, on one hand, the executive teams inside the organisations have to focus harder on the customer and actually are thinking more about customer outcomes, and on the other hand, trying to actually appease the investment community, they are actually being pulled potentially in 2 different directions at the same time.
That's right. That's right. And I think looking after the investor is a longer term process. Rather than the short-term one. And I think just taking that short-term pressure off of itself could help the banks in terms of changing the culture to how they deal with their customers.
Mm. And another thing about the culture, which you may be able to comment on, is that it seems to me that some of the frontline bank employees, the people who are actually in the branches and actually serving customers, are also on the damp end of the stick, as it were, as well, because essentially they're quite often being encouraged and enforced to cross-sell and upsell and do all those things that perhaps lead to the wrong outcomes for customers.
That's right. I have a strong point of view about that, and I went on a program on Channel 9 articulating that, and I think the staff are the meat in the sandwich, and I think they've been unfairly treated. And the other thing is that because the banks, there's a lot of disruption taking place, by definition, there will be a number of redundancies. So staff have got twofold pressures. 1, the fear of redundancy because of technological change, and 2, the fear of underperformance in terms of the criteria. Now, I think that what's fundamentally wrong with the banks is that we talk about the neglect of customers, but I think it's also neglecting frontline staff. Mm-hmm. And if you look at some of the scandals that have happened, you take the CBA Austract issue, what's become apparent is the frontline staff knew about that. And they protested. And they knew, without any regulation or prescription, that's the wrong thing to be doing. They didn't need the law or regulation to tell them. They came to the conclusion of wrong behaviour. Yet the senior management wouldn't listen to them. Now, I've been at the ANZ at the time when the CEO, John McFarlane, took the opposite point of view. In the retail bank, he transformed that bank because he changed tactics. He took a deep interest in the people at the coalface. He listened to them. And when he put an operating model in to deal with that, it was amazing, the ideas and information that came up. But more importantly, it dramatically changed the morale. And in effect, you didn't have to ask staff to relate to customers because the way staff were being treated by senior management naturally flowed through to helping the customers. And this is something that I don't think is being addressed, not that Haynes have been mandated to do that, but I think that's an important observation. And I think all this stuff about culture change and what they're planning to do, I don't think is as difficult as all that. And some people say it's going to take years, decades to change the culture. I don't agree. I have seen one bank, through John McFarlane, change that culture within months. And I believe there is a model where they shorten the distance between the chief executive and the front line, and they listen to the front line, and they in effect empower them. In banking, is very regulatory driven, and that drives everything. It drives, what you can do and you can't do, and all sort of stuff. And frontline people have way less flexibility than they do in other organisations. But what John McFarlane learned was there are a lot of things where you can give staff flexibility. You can give them some discretions to make decisions. And what we tend to forget, that the frontline people in their banks, they are decent, hard-working people. And we dumb them down. And it's silly. Because if you appeal to the natural characteristics of frontline people, on the whole, you'll fail now and again, but on the whole, you will win. And I think it's a fundamental issue that even goes beyond culture. It goes to interpersonal relationships, and that's what's gone wrong with banks. And if you go up the organisation of the bank, there is tension between all the levels. because of the downward pressure on performance, it's permeated the whole organisation. So it's not just the frontline staff, but the frontline staff is a good place to start.
And I wonder whether the fact that many banks have now got into multiple lines of business and are running both horizontal and vertical integration models, so they sell and advise.
That's the other thing that's happened. Banks have become very, very complex institutions. If you look at them, they have a number of activities which are very different. And the dynamic of being successful in each of those activities is quite different. And then you have a geographical dispersion. So it's very hard, in my view, to manage a bank. They have become overly complex, not the least of which is because of regulation. And I think that what's happened is that management can't effectively manage them because they haven't been listening to the frontline people. Now, if you look at a modern bank, there are so many layers and so many activities. How do you do that? Now, what John McFarlane did is he pulled out a division and said, I'm going to do that in relation to that division. And he probably, I'd left by it, he probably applied the same principles. So, in fairness to them, they've become very complex. The other thing that's happened is there's a certain sameness about them all. You could put the ANZ badge on Westpac and you wouldn't know the difference. And that's partly the fault of Apra, who have got this one-size-all-fits regulation. So this argument about vertical integration, I think there's a deeper argument about that, and that is not whether vertical integration is right or wrong, but the capacity of an organisation to effectively manage the situation. And I think if that's the starting off point, you could come to a different answer about vertical integration. For instance, I can imagine a small bank that did have vertical integration, say in the one of the areas at the moment, financial planning, and I think that if it were properly managed, it could be handled. But the fact is that our banks are so vast, that's very difficult to do. So I think there's another conversation, or shall I put it, another dimension to the conversation that should be taking place.
Okay, very interesting. And it sounds to me as though what we're really saying is that whilst regulators may be able to do a few things around the edge, ultimately it has to come back to the executive and leadership teams inside those organisations to really think about their businesses differently.
And in fact, model. That's right.
Yeah,
that's
and
right.
in fact, unlearn some of the stuff that they've been doing for the last decade plus. And I guess the question then in my mind is, the senior leadership teams inside those organisations today who've been brought up in the current mode of thinking, as it were.
That's right.
What's the chances of them being able to effectively break out and head in a different direction?
Well, that's interesting because, and I'm only reading from the newspapers, I don't have any direct information, but I noticed that Shane Elliott is deliberately going about downsizing ANZ. I mean, not only has he quit offshore, but he's also substantially revising his model, creating a number of working groups and making the work closer to the customer. Now, there's some very interesting academic work that's been done on that. And in a recent issue of the Harvard Business Review, there's an excellent article on what's called the End of Bureaucracy. And they've identified a couple of companies, very large companies, that have been absolutely outstanding in the way they've revised their models to, in effect, a number of small cells. Now, what you'd immediately conclude, how in the hell do you manage multiple cells? Well, the bottom line is that there are a couple of international companies that have very successfully done that. And I think they're the kind of discussions that we should be having. My question would be, how practical is it in a bank to go down Shane Elliott's path and have a number of these cells who've got a limited range of products, but they've got very good customer contact? How do you manage? Because we're not, on the whole, we're not used to managing models like that. We've got the vast array of divisions and top-down management. So what should be taking place at the moment is a discussion about models. What is the best model for a bank? Now, the last thing I want to see is for each of the four banks to adopt the same model. That's the worst thing that can happen, because it's only when people try different models do we get innovation. If all four follow Shane Elliott, well, we're just exacerbating the issue. What I'd love to see is each of the four take a very different path, Now, I don't mean in being in different activities, or getting rid of that or going into that, or a bit of geographic change. What I mean is a fundamental change in the model. And what we need to do, we need to debate that, and we need our best consulting and other brains in the country to think about bank models. What is the best model for a bank in the current state of the market, where you've got fintechs coming away, attacking them at the edges, and which is a good thing. So it couldn't be a better time. On the one hand, you've got the Hayne inquiry. On the other, you've got difficult times coming. You've got regulatory pressure, and there are other things that are coming. You couldn't get a better time, or more importantly, you should be reviewing your banking model in the light of all these fundamental changes and disruptions taking place.
No, I agree with that, John. And I've had this theory for quite some time, is you start from the customer end and you work back into the organisation, rather than actually building an ever bigger machine that effectively becomes more like a sausage machine rather than anything else, and chuck stuff out at the end, whether it's relevant for the customer or not, which is the way most of the banks work at the moment.
That's right. I think what's tended to happen is too much top-down managing and too much top-down analysis. And what it means is that we get products and services that really aren't attuned to what the customer wants. So what flows from that is a hard sell. Now, if a product and service is very good, price might be absolutely secondary. The fact is that customers will go for it. So you don't need to drive your staff into selling a second-class product or a second-class service. And I think that's been another factor too.
So that would suggest that the whole question of how you incentivise and reward staff comes into focus, how you structure the organisation and the processes that you run within the organisation, and in fact which businesses are you in and which customer types and groups do you service should all be questions which are on the table. Yeah.
That's absolutely right. Now, I think there's a couple of models at the moment that have worked. I think the Bendigo Bank model, which is basically a customer-built model, has done well, and I noticed that they do very well in the customer the satisfaction surveys. Now, the other model that's done very well is Macquarie Bank.
Yep.
Now, when you look at Macquarie has got a very narrow product line, but it has gone like an infrastructure, but where it's gone international, and it's not impossible for Macquarie Bank in the next couple of years to be more successful than one of the main banks. Now, if the four trading banks don't fundamentally change their model, their growth is going to be limited, and I think they'll have investor problems.
So, two questions which sort of are tangential but important. The regulatory framework, right? We have the RBA, we have APRA, and we have ASIC, all of whom have bits of the components of trying to manage the banks. Have you got a perspective in terms of how effective that whole set of processes have been and whether it actually is fit for purpose?
Yes, I do. It's really silo regulation. And the difficulty is that each of those silos is very distinctive and is very powerful in its own right. And that regulatory agency has its say in relation to its territory. And there hasn't been enough cross-referral or working together. Now, it's been suggested that the way to do this is through the
Council of Financial Regulators?
Yeah. Now, that's not going to get there because that's at the very top level. Where you need the cooperation is down at the coalface. I mean, I think it's very curious that we get a problem in a bank, and what happens is it is one of the regulatory agents that tackle that problem. Now, I think if you analyse that problem, it could well be multifaceted. and it needs a bit of this, it needs a bit of that. Now, there's two answers to that. You either have one regulator that encompasses them all, or you have a better way for the regulators to work together. And I don't think that's just at the top. That's got to be at the operating level. And I think there needs to be a lot more discussion yet as to how that's resolved. The other thing is that the regulators, each of them have been a failure for a very good reason. Apra really, and I've written an article about this in the IPA review where I've outlined why Apra is a failure, in my view, a sham. And that's because it is fundamentally controlled by the banks. There is not enough independence in Apra itself. The bank's funded, and a lot of bank staff are in Apra. Also, it's short of funds. Now, ASIC. Now, I have a problem about ASIC because I've noticed that when a difficult problem comes up and the banks are fighting it, they fight tooth and nail. Now, I know one transaction, way past my time so I can talk about it, the receivership of the superphosphate company in Western Australia. Now, my information is that the ANZ Bank put 5 QCs into that case to fight it. Now, the difficulty is that if the case is important enough to the bank, more often than not, they put huge teams on them. They can out-resource ASIC many times over. In my view, ASIC, as it has been, it's got impossible. And when ASIC gets criticised, I say, oh my God, they've got all these problems to look at. If I pick this one, I'm going to have a truckload of QCs against me. If I pick that one, I'm going to have another truckload. How am I going to cope? So I have some sympathy with ASIC. The other thing about ASIC, I find interesting about ASIC is when you look at its funding model, it also receives a lot of revenue, which will be noticed in the papers, but also it generates a lot of fines. And so looking at the financial effectiveness of ASIC, I know it mightn't sound very good policy, but you really have to look at ASIC in terms of, one, the revenue it raises, and two, the penalties it succeeds. So, with Chipton coming along, it is a good thing, it's changed. The previous bloke would have been a disaster because he came out of the Commonwealth Bank, which would have been, so it's good for him, good for the Commonwealth Bank, and good for the country that he wasn't appointed. He's probably a very competent individual. But Chipton is come from outside the market and comes with a fresh mind. But still, having said that, it will take massive funding to fight these cases.
Sure. And of course, that's quite often why they go for the enforceable undertaking rather than the legal route.
Well,
because,
that's right. And there's a very interesting article today by in the I think the Australian that deals with this and deals with the Westpac case. And I can understand why they've gone for enforceable undertakings. And I think we've got to be careful about criticising them.
Oh, indeed. So it sounds to me as though the regulatory framework, the structure, is probably not really optimal, given what you're saying. And of course, it'll be interesting to see.
There needs to be more thinking about the regulatory structure. I'm not too sure whether the Hayne inquiry is the right way to go. I don't know. For instance, I'd like to say something, and what can I do? I could put a paper in. The way I'd like to see something like that signed, resolved, is to get a key group of people around that are independent, that are policy-driven, don't have vested interests, just literally want a good outcome, and to think through all the issues, because it is a multifaceted problem.
Yep.
Which require a multifaceted solution. And I think we need more intelligence. And obviously you'd look at overseas models to see which works overseas. But plainly, ours is not going to work. I don't have the answer. But I think there is an answer. It requires deeper and more intelligent discussion.
Interesting, and I absolutely agree with you on that. And I think a fresh pair of eyes and a different way of looking at it is the right way to go. You can't give it to the existing entities to say solve your own problem, because it's clear to me that they haven't been able to solve it. No,
definitely not. Because look what's happened in the last 2 weeks.
Yeah.
Treasury has obviously influenced Frydenberg to reappoint Burns, which is an extraordinary decision to take.
Yep.
But what that does underlie is the power of Treasury. And I think that the elephant in the room in this whole discussion is Treasury. Treasury is a very, very powerful government agency. It has, through the Treasurer, it has a huge influence over whatever government's power, their policy. But it also has huge influence through its, what you might call, its sub-agencies. And it's by nature very conservative, and it's got one goal, which is not the consumer, which is safety. So their influence, in a sense, needs to be rebalanced.
I agree with that, and of course we've already seen some.
They're very pleased about the fact that Burns has done such a good job in terms of saving us. Now, I don't entirely agree that he was the one that was responsible for saving us during the global financial crisis. And I think the other criticism is that what he's fundamentally done, he's, having spent all his time in Switzerland, he's extremely knowledgeable, as you would expect him to be, extremely knowledgeable about regulatory things, capital and stuff, and he's just applied to Australia the international standard. Now, I don't think that's necessarily into Australia, because the Australian banking system is different to the other banking systems throughout the world. And I think each country needs a different, a modified regulatory framework. I mean, there's a lot of things will be in common, but we have our problems are quite different, and the emphasis in our regulatory policy should be different. And the transfer of international things, holus bolus, to Australia, and being the front runner internationally in adopting these things, I think is extraordinary. But that, to my way of thinking, demonstrates the power of APRA and the power of Treasury. And where is the countervailing argument? Where is the countervailing power? And one of the troubles in this area is the Treasury has a vast amount of information, highly intelligent people working for it. Who are we? Who are you and I, with our limited resources and intelligence, able to critique what they're doing? It's hard.
No, I agree with that. I think I also make the other point that the international rules around, for example, capital adequacy and the Basel rules, have effectively led to this massive overlending into the home lending sector in Australia, with 65% of all lending in the banks to home lending, with very little capital buffers, right? And as a result of that, we've had minimalistic lending towards the SME sector, and we've also now got significant risks in the system. So it shows that just focusing on the regulatory capital structures doesn't get us to the right business outcome.
Yeah, I've been writing about that for a while, and I think the first paper I wrote on this about 2004, and I think it's one of the longer papers I've written, but I think that was one of the main things that worried me, was the imbalance of lending between the residential mortgages and small business. And since I wrote that, I haven't looked at the figures recently, but I understand they've got worse. So there's a powerful argument that APRA has done the reverse. Through its policies, it's made our economy more risky. And when you look at the household income and the residential mortgage, by almost every benchmark you apply to it, by comparison with other countries, it's way too large. And my view is that's a serious risk. And the difficulty about it is that you can't make a sudden change with that. To get the balance right between residential mortgages and business lending, you can't do that overnight. You can't suddenly withdraw lending from that household market and go into small business. I mean, there'll be mechanisms which I've seen today that will help small business, but it is very wrong to suddenly, after many years, hey, no, that's wrong. We've got to go back the other way. So we get this flip-flopping, and that's dangerous. And what's happening at the moment is dangerous, in that there are too many things happening to wind it back too quickly. It needs to be more measured. But at least it'll be done against the reality that this part of the banking sector is too large and out of balance. So let's take a more reasoned approach of how, over a period of time, we might get it in balance and not adversely affect people at the moment. I'm hearing lots of friends in my office of young people who are wanting mortgages. And the way that's changed in the last 6 months is absolutely incredible, because I have them coming to me, and because of my experience as a lawyer, they come in, well, John, what do you think of this? And I am dumbfounded about the change, the degree of it. And that's what's bad. You can't take huge fundamental changes like this quickly. You must take them gradually. You must give the time for the market to adjust, and not suddenly black and white. It's bad. And the other thing about all this is that when you talk about risk, risk is multifaceted. Risk is quite a complex thing. And you can over-regulate and you can over-analyse risk. And I think we're in danger of doing that. To give you an example, if a borrower comes to you and he's got a house worth $500,000 and he wants to borrow $100,000. Now, that's a very different proposition for someone that comes along and wants to borrow $400,000. Yet, what the situation will be that the requirements for each case will be the same. Now, why would you put someone who wants a $100,000 mortgage through all those loops when the risk factor is completely different? So what's lacking at the moment, again, is a bigger segmentation of the issues. And the difficulty is that we have a situation where regulation applies equally to everyone, so applies equally to everyone in every situation. And that's unintelligent.
Yeah, and it needs to be more calibrated, doesn't it?
When someone's borrowing, when someone's borrowing 80 or whatever it is, 85%, you've got to do the kind of things that have been mentioned, but not for someone's borrowing 100,000. And it's this problem in banking of recognising exceptions. The banks have got too large. It's hard to manage exceptions, because what an exception means is that you are giving to someone the authority to say, hi, in this situation, we don't need all that paperwork. This is a safe bet. You know, I've been banking all my life, the fellow will say, and that's as safe as hell. So why, put him through all this stuff and maybe deny him the thing because one of the criteria he won't meet. And he can't get the application. Yet, in fact, if you look at the underlying risk, no problem.
Yeah. But you see, that takes intelligence, not just a standard structured system and a standard result, right?
That's right.
That actually requires the banker to be a real banker rather than just a data processor.
That's right. Well, if you take yourself back to the old branch manager, 20 or 30 years ago in a market, a suburb or a country town, those guys were very experienced, and they knew intuitively whether to bank someone or not to bank one. And they would probably bank people that you, on the face of it, you'd be frightened to bank. And there'd be other people around the place, big flash lifestyle, you wouldn't bankroll in a fit if you knew all the facts. And the old-fashioned bank manager, who was well-trained, understood risk in all its dimensions, and in effect filtered the loans for the system, meant that we have less of the problems we've got today. And because it got so big, so complex, they've got the bigger, the more complex they are, the more they've got to standardise all their processes, and the more it's got to mean the same thing for everyone. That's why there's a strong argument for saying, for breaking up the banks to make them smaller, so we can collapse that chain between the CEO and the customer.
Yeah, no, absolutely right. I have two other little areas to explore with you, John. The first is I'm very interested in your perspective with regard to the derivative operations within banks and the risks that are represented there, and whether in fact you think that's got out of kilter. I mean, there are people talking about, Glass-Steagall or some other structural separation. Be interested in your perspective on that.
Let's give you a little bit of history about that. When I was chairman of ANZ Audit and Risk, the thing that worried me more than anything else was derivatives. And I've got to be honest, I found them extremely difficult to understand. I was very fortunate. I had two outstanding people, one Peter Marriott, another lady called Judith Downs, who've both gone on to do big things in banking. And they spent some time explaining it to me. And what I felt was that I would understand the derivative for 10 minutes, but if you asked me the following day, I couldn't understand it. So I started with the proposition that to really understand derivatives, you've got to be a mathematician. And I'm not a mathematician. Now, the other thing is, the issue for me about derivatives is that we need to segment them. There are good derivatives and there are bad derivatives. I mean, when you look at banking, which is basically, it's got an asset side, it's got a liability side, and they don't match. And to be an effective bank, you have to be able to match the liabilities on both sides, which means they do need certain kinds of derivatives to do that. And that's what I call proper and appropriate derivative trading. Mm-hmm. Now, at the end of the scale, you've got casino-type derivatives. That is, derivatives that are driven by people not to create some underlying value or having any underlying purpose, but just to make money. And one of the reasons that derivatives have grown so large is there's been a shift away from good fundamental derivatives to the gambling derivative. And the difficulty we have in debating this subject is that what we need a segmentation of all the derivatives so we know exactly what's going on. My idea of the good derivatives and the gambling derivatives is too crude. You need much more nuance and segmentation to understand it. But I think when you do that segmentation, and by the way, there should be much more reporting about those segmentations and a better understanding of what the purpose of that segment is. Yeah. And I think when you get that information, I think you'll find that there is a huge danger in a lot of the derivatives trading that's taking place at the moment. And they're not adding any value, and to stop them is not going to disadvantage the banking system at all. Now, there'll be a lot of people deny that because there's a lot of people around in the marketplace that are gambling with these derivatives, and with superior information and mathematical skills, they're probably making a lot of money. And the argument will be, but what all the banking is about is arbitraging. This is just another form of arbitraging. Well, I think there's a very big difference between arbitraging, borrowing from you to lend to me, as opposed to trading in the particular mortgage that's been created between you and me. Now, I accept there should be some trading with mortgages because you can bulk them up and you can get more capital to do more. But with derivatives, there's a lot that, in my view, have a poor purpose. And there's not enough discussion about the inherent risk. And I think at the moment there's a huge risk with derivatives that we're not facing up to.
Well, we certainly know that the values written are way multiple times the value of the economy, right? And nobody knows how big the risks are and in what circumstances those risks could come home to roost. Yeah.
And I'm a bit surprised that this is one area where the various country and the international regulatory agencies, they should be right onto this. What's completely lacking is any understanding of the derivative market. How do you segment them?
Yep, I agree.
What's the inherent risk in each segment? What purpose does each segment serve? Is it really necessary? Is it necessary in the sense of the risk to the economy or the risk to the institution? Also, who holds all these derivatives? Do they have the power to meet the claim if one is made? What they'll say, oh, that's all right, but we've got derivatives on the other side.
That's right.
And that might be correct. But the trouble is you don't know where all this ends up. You've got to, what you've got to do is you've got to call up every derivative that exists in the world and see what's left. Who, at the end of the day, holds the risks? Yeah.
And the answer is nobody knows. Nobody knows. No, indeed.
Nobody knows. That's right.
Yeah. So I agree with you. It's a huge risky area, and it definitely needs different attention.
But the very difficult thing about it is that for you and I, or certainly for me, is truly understanding the way a particular kind of derivative works. And whenever I'm faced with one in my workplace, I have to spend some time understanding its dynamic.
Yep. Well, I used to teach capital markets for 20 years or so I understand the derivatives markets quite well, and I can tell you that the risks in the system are understood by very, very few people around the world at the moment, and the numbers are huge. And of course, there's a risk of cross-contamination between the derivative activities of the banks and the meat and potato lending and deposits of banks, because they're all sitting under the same roof, which is one of the reasons why I believe that we should be teasing some of this apart.
Well, the other aspect of this is, of course, it's international.
Yep.
Now, our residential mortgage is just in Australia, but the derivative market, I suspect, don't know, I suspect it's one of the most international of all the banking activities that exists.
Yep.
And you could probably argue that there's a huge amount of independence around the world on derivatives.
I think you're right. John, I have one other area I'd like to explore before I let you go, and that is I'm very interested in the relationship between the economists that live inside the banks and who make their predictions about where home prices are going to go and what inflation's going to be. Because my observation is that they seem to be at the very conservative end of the spectrum relative to other people's opinion as to where home prices may go. And I'm just wondering whether being inside these large organisations constrains them in terms of the way that they think about some of the issues that may be being confronted. What do you think?
Well, I have heard some noise that there may not be as much independence as there should be. And all I can do is to go back to my time when the economist was Paul Eslake, who's subsequently left the bank and gone on to do bigger and better things. He was fiercely independent. And I'm quite sure that he would have never produced a report that he didn't really believe in. And I think if you attempted to manipulate him, you'd have a problem. So he, at my time, his independence would have permeated the people that were making the kind of decisions that flow out of that. Now, I've heard that that's changed. And I can understand why it might have changed, because this might be part of all the overall pressure on banks to perform and deliver certain things. That there's a tendency in the organisation, economics is not a finite art. Anyone that pretends it is kidding you. There is, in any situation, a range of opinion you can have, legitimately have. So unfortunately, it's an activity where there is a natural range. And where there's a range, I suppose that's where the risk is. That between that range, you can be pushed or influenced by the people around you. But look, I have no direct evidence of what might be happening at the moment. I can only speculate.
No, fair comment. No, it's interesting because the expectations from many economists outside the main banks seem to have become more and more negative, whereas the people inside the main banks are still holding to their view. And I've got a theory, I can't prove it, that it may be something to do with the fact that if they start going more negative, then they have to up the provisions. And therefore, suddenly the results of the bank don't look as good. So therefore, there's a little bit of a need to be a bit more conservative to sort of maintain the financial shape within which we operate. So, well, who knows?
Well, I'm a great believer in behavioural economics. And I think, going back to Adam Smith, whose moral sentiments and believe that almost every economic principle is reinforced by some kind of behaviour. That's where I come from. And so I think there are probably natural things that are taking place that might be pushing you from one end of the range to the other. Look, there's one thing that we haven't covered, if you've got a minute.
Sure.
The question of complexity of the banks.
Okay.
I think there's an argument that we'd be better off if we scale back the banks. Now, I say that for the reason that, not because I want to dilute their power, because I'll fight that like hell, as will Treasury, but because I think they can be more effectively managed. And when you look at other sectors, there are people that have done some first-class demergers where the sum of the parts after the merger has been fantastic. And I wish I had at my fingertips what those transactions were. So, irrespective of this business about all the derivatives and where you might place the derivatives, I think there's a powerful economic argument and a shareholder argument that it pays to demerger. Now, if you're going down that track of demerging, I think there's a very important issue there, and that is that the government have guaranteed the deposits. Now, I think a government should only guarantee the deposits of a retail bank.
Okay.
So that if you demerged and you had a retail bank and you had a commercial bank, what you could do in the retail bank, that would be the one that got the government guarantee on the deposits. They would be limited in terms of their derivative trading to what they need to do to match their assets and liabilities. Any kind of trading or speculation would be in the commercial bank. Now, once you do that, that means that frees up the commercial bank to take a different attitude on risk, to have a different capital ratio, to employ different people, to go for different markets and different rates of deposit. So that freeing up has to be, in my view, in the interest of better management of the banks and in terms of shareholder and customer expectations. So I look at it and I say, now, why wouldn't you do it? Well, sure. If I was CEO of a bank, I don't think I want to delete my power.
Yeah.
If I was Treasury, no, I don't want more companies to manage. If I was Apra, oh, no, 4's enough. If it's 8, it's going to be more difficult for me. And on you go. So what would be fantastic would be if one of the banks faced up to this and did a demerger along the lines I've indicated. Retail, commercial, insurance, financial planning, whatever. I think you'd get accolades from the marketplace. And by that I mean consumer, shareholder, market generally.
Yep.
And once one bank does it, the game's on. Because that bank, although the demerge things, not only will solve a lot of Haynes' problems, but it will produce better outcomes for everyone and will force the pace with the rest. Now, one's tempted, therefore, for government intervention. No, we shouldn't have government intervention. The problem about demerging is that there are difficulties in doing it. There are some inhibitors.
Yep.
There is capital gains tax. There is stamp duty. Now, I think if the government had a period of 2 years or whatever, where there was exemptions from stamp duty and capital gains tax to enable banks to demerge, so there was no, so the transaction costs were a lot lower, then it would happen. And at the moment, there are lots of corporate reorganisations. I mean, take BHP's got a problem with capital gains tax. And I think it's wrong that we have things like stamp duty and capital gains tax that are locking up the models in any business. And I think the community is much better off if these inhibitors to remodelling are removed. Now, there's a difference between removing inhibitors to remodel as opposed to people that are paying tax and stamp duty, playing with tax and stamp duty. Oh. The genuine demerger is, you can smell them a mile away. So I don't think it's difficult for the government to do it. And I think the government that says we're going to have a moratorium, whatever, to allow companies, including banks, to consider demerger. I think if you did a cost-benefit analysis, I think the economists could prove that the trade-off between capital gains tax and stamp duty gain, as opposed to value in the community, it'd be a very interesting calculation, beyond me to do it, would be very revealing. So if someone takes the lead on this, it will be a very interesting community discussion.
Well, John, I think it's a very interesting and visionary idea, because what you're really saying is that with the right government incentives, there is a path for the financial sector to effectively manage itself through to a better future that is more customer aligned, that is generating more shareholder value, is reducing complexity and reducing risk.
Well, I'd like to turn it around the other way. What's the argument against it?
I can't think of one. Except the existing power base and the fact that people are wired to a particular way of thinking about the way things work.
Yeah. You see, I don't think it's particularly visionary. I think that's overstating it. It's not really because it is very easy for the government. I think they could easily get the legislation through both houses of Parliament. And I think you can develop a policy where, whether they're on the left or whether they're on the right, they will see the good sense of it. And I've tried to look at it from the point of view of the people on the left. Why would they object? Of the people on the right, they'd probably be in favour because they're sort of free enterprise motivated. So I'd love to see that discussed in the marketplace.
Well, the ideas will definitely go out on the Digital Finance Analytics channel, and I'm sure that they will get shared far and wide because we have quite a good following. So that's good.
Do you?
Yes, we do. Yeah, and not just in Australia, but also around other countries as well. So,
my goodness. You perhaps should have told me that before I've been started to talk.
John, I appreciate your time. Thank you very much for your frank and fearless conversation today, and certainly we've covered a wide range of issues. I really appreciate your time, and I'm sure that my followers and listeners will be very appreciative of your ideas and your perspective.
Well, look, if there are any questions, come back to you that are worth answering, I'd be happy through this medium to answer those questions, because what I find with stuff like that is you don't know what your audience is really interested in. And I always prefer to do it by question and answer, so that you talk about what people want to listen to. There's probably only 5% of what I've spoken anyone's interested in. So if that's the case, there's a few questions in that 5%, I'll be happy to answer them.
Okay, well, John, thank you. Well, let's leave the door open then. So for those who are following and watching, if you have questions for John, put them in the comments below and I'll collect them, and perhaps I can do a follow-up with John down the track. Good. Thank you very much, John. It's been a pleasure to talk with you.
That will give me the opportunity for correcting mistakes, won't it?
It's only opinion. John, thank you very much. I appreciate your time today. Thank you so much.
Good.
We'll talk again soon. Thank you. So there you have it, a really interesting perspective from someone who really knows the industry well. If you like what you've seen here today, please add a comment or a question and check back again for the latest updates. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you in the next post.